Welcome back to the deep dive. Today we're digging into something pretty interesting in the corporate world. It's this paradox around top salespeople.
hmm
They make great money, obviously, driving revenue. But when you look closer, they're often kind of self-funded. The line between their own cash and the company's money gets really blurry.
Oh, absolutely. It's a constant tightrope for managers.
Yeah,
You need these people fired up, motivated, spending what it takes.
right.
But at the same time, they're managing this huge chunk of company expenses,
Yeah.
often way outside the head office's view.
Exactly. So our mission today is to, really unpack the systems used to manage these sales teams.
Mm.
We're looking at three big things: how quotas get set, how commissions work to drive performance,
And the big one.
and yeah, the really critical part, how companies try to control those huge and often kind of controversial travel and entertainment expenses. T&E.
Yeah, and we've got some great stuff to look at here. Some academic work, but also real case studies. We've got reps like Rick, his manager Gino, a company called Majestic Plastics facing a budget crunch. Plus hard data on costs and how IRS rules shape all of this.
So we're really trying to uncover the incentives, the rules, the strategies, basically what decides if a sales team is generating pure genius or, well, as some managers seem to fear, maybe even grand larceny.
Uh-huh. Yeah, that's the fear.
Let's start right at the core. The money, the incentives.
Okay, first stop has to be the quota. This is really where the risk and reward crystallizes for the salesperson. Let's look at a company like Security and Protection. Their reps get a straight 5% commission.
Sounds simple enough.
But, and this is key, they pay their own expenses out of that 5%.
Ah, okay. So they're like mini entrepreneurs running their territory.
Right.
If we take Rick, the example rep, say he hits his $1.25 million target. That's $62,000 commission.
Right.
But if his travel, meals, entertaining clients, if that costs him $15,000, his actual take-home drops quite a bit. He feels every single expense personally.
Precisely. And that's why the quota itself isn't just a target. It's more like a financial launch pad. Because once you hit that number for the year, the bonuses really kick in.
How does that work?
Okay, so you hit quota. Boom. You get a 1% bonus calculated on the entire quota amount.
On the whole, $1.25 million in Rick's case.
Exactly. So that's $12,500 right there. Plus, you get an extra 1% commission on all the sales you make over the quota.
Wow. Okay, let's pause on that. That's a powerful mechanism. That $12,500 bonus just for hitting the number, that could cover his entire year's expenses right there.
Often, yeah. It
Yeah.
really separates just having a job from, making serious money. The quota is everything.
And that intensity creates this weird dynamic, right? This sandbagging thing we see with Rick Gimber.
Yeah, exactly. Rick's a star performer, but he digs his heels in. Refuses to accept a quota higher than $1.25 million.
Why?
He's afraid of that cycle, that damned if I do, damned if I don't situation.
Meaning, if he crushes it one year, sells way over quota.
Right, say he sells $1.8 million. He knows management will just look at that data and say, okay, next year your quota is $1.7 million.
Making it harder to get that crucial bonus next year. So performing too well almost penalizes him down the line.
That's the fear. And the leverage someone like Rick has is huge. Gino, his manager, tries to push him, but Rick's so valuable, Gino actually backs down.
So the quota isn't just set, it's negotiated.
With the top performers, absolutely. It becomes this internal high-stakes negotiation because the compensation is tied so directly to that number. Management kind of loses some control there.
Okay, so that rep power runs smack into corporate reality when we talk expenses. Because T&E it's just massive. We're talking, what, 5 or 6% of total sales sometimes?
Easily, which for some companies is more than their entire profit margin. It's huge.
The scale alone means you have to pay attention.
Definitely. Our sources, even using older data from like 2002, just to show the baseline, paint a clear picture. Back then, in a city like Atlanta, just meals in a hotel room averaged about $236 a day per rep.
Per day, so a standard 5-day week on the road.
You're already looking at almost $1,200 just for food and lodging. And that doesn't even count getting there or getting around town.
And costs have only gone up since 2002, obviously. So because the numbers are so big, how a company handles expenses isn't just admin, it's strategy.
It absolutely is. Think about startups. They often can't handle big fixed costs. So what do?
Make the rep pay everything.
Right. They require reps to cover all their selling costs, but they offer a much higher commission rate in return. It makes expenses purely variable, tied directly to sales. No sales, no expense payout from the company.
But then bigger, more established companies might do the opposite.
Exactly.
Yeah.
They might use a generous expense account, maybe a company car, as a way to attract talent. Maybe recent grads who don't have savings.
And it projects an image too, right? Like
Yeah,
success.
that image of prosperity.
Yeah.
You want your rep looking sharp, taking clients in nice places, especially for high-value deals.
And this strategy evolves. We saw that shift in the 90s towards tech, right?
hmm A big jump between 94 and 98. Companies willing to pay 100% for productivity tools shot up. Laptops went from 28% reimbursement to 65%. Car phones, remember those, 38% up to 61%.
Shows a clear priority. Give the reps the tools they need, maybe cut back elsewhere, but invest in the tech that helps them sell.
Right. Better tech beats a slightly cheaper meal budget, seems to be the thinking.
But no matter the company's strategy, lean or, more generous, they all have to deal with the IRS.
Ah, yes, the tax man. Government rules really dictate the playing field for expenses, and this is crucial. Since 1994, companies can only deduct 80% of legitimate business entertainment costs.
Only 80%.
And even less for meals, only 50% of business meal expenses are deductible when the company files its taxes.
So half the cost of every business lunch or dinner the company pays for, they actually pay taxes on that amount.
Effectively, yes.
Yeah.
It makes those really high-end client dinners less appealing from a pure cost perspective.
Get super specific too, like with gifts.
Oh, yeah. Strict limit there. Only $25 per recipient per year is deductible as a business gift.
$25. That doesn't go far.
Nope. So to stay compliant, company policy has to be really clear on what's a legitimate expense. Generally, it's two things. Actual business costs, like, say, using your phone for work.
Okay.
And personal costs you only have because you're traveling for work, like a hotel room. You wouldn't need that if you were home.
Makes sense. And we have that average U.S. per diem figure, $215.
Oh, yeah. $215 covering car, hotel, and meals.
And the breakdown of that is interesting too.
Very. Hotels are the biggest chunk by far, like 53%. Then the car at about 25%, and food's the smallest at around 22–23%.
Why so much on the hotel? Are reps just living it up?
Not usually. It's often driven by that image thing again. Management wants reps in decent, centrally located hotels for client access and maintaining that professional appearance. It's almost a structural cost, less about luxury.
Okay, that image focus brings us back to gifts and entertainment, which always seems controversial.
It is. Most companies allow for, ordinary, reasonable, entertaining. But with those IRS limits we talked about, plus just the rising costs, it's definitely dampened management's enthusiasm, as our source puts it.
Leads to tighter controls.
Or even extreme stances. Look at Walmart. Their buyers are strictly forbidden from accepting anything from a supplier, not even a can of Coke.
Wow. Just remove any possible hint of influence.
Exactly. Zero ambiguity.
Okay, let's pivot to how this plays out inside a company. The Majestic Plastics case sounds like a classic management headache.
It really is. Clyde Brean, the manager, he's got this task. Cut travel costs significantly.
Yeah.
But he can't kill Salesforce morale in the process.
The classic spreadsheet versus people problem.
Totally. And the obvious cost-cutting options all have morale trade-offs. Switch from first-class flights to coach.
Your standard move.
Mandate buses or Ubers instead of taxis. Stay at a Holiday Inn instead of the Hyatt. Easy savings on paper.
But maybe makes the reps feel less valued.
Could be. But the really high-stakes tactic for morale is the Saturday night stayover.
Yeah. Explain that one.
It's purely about airfare. Weekday round trips are expensive. But if you make the reps stay over Saturday night, the airline ticket cost can drop massively, sometimes by half or even more.
Huge savings for the company's budget.
Enormous.
Yeah.
But the cost to the rep, their weekend, their family time, it's asking for a big personal sacrifice purely for the company's bottom line. That's a tough sell.
Yeah, I can see that causing serious resentment. And it's amazing how even small changes in control can have big effects. That example of tightening receipt policy.
Well, yeah, that was telling. One company just lowered the threshold for needing a receipt from $25 down to $15.
And saved?
19%, almost immediately.
Wow. That suggests there's a lot of, let's call it casual padding on those small unreceipted items.
It certainly implies it, which leads right into what makes a good expense plan work. The core principle. No net gain. No net loss for the rep. They shouldn't end up poor because they had to travel for work. Their net income, after expenses, should be roughly the same whether they're on the road or working from their home base. If travel actually costs them money out of pocket, morale just tanks.
And it has to be fair across different places, right?
Yeah, absolutely. Got to be equitable. It costs way more to operate in New York or Boston than it does in, say, Omaha. The plan needs to reflect that reality.
So what's the absolute worst practice, according to the sources? What should companies avoid?
The big warning is, Don't use expense allowances as a substitute for actual salary.
Like giving a tax-free expense budget instead of a taxable raise.
Exactly. Reps might even prefer it initially because it feels like more cash in hand. But it completely destroys management's ability to control costs. And worse, it basically encourages fudging the numbers and potential tax issues. It blurs the line between legitimate business costs and just extra pay. It's a really bad idea.
Okay, so avoid that trap. What are the main legitimate ways companies try to control expenses? Seems like three main approaches.
Pretty much. First, the simplest. Reps pay their own expenses, usually tied to a straight commission deal.
We talked about that. Simple to run.
Costs nothing to administer.
Yeah.
But management gives up all control over what the rep does. They'll never chase those long-shot deals far away because the risk and cost is all on them.
Okay, method two.
The unlimited payment plan is pretty common. The company pays back all legitimate documented expenses.
So maximum flexibility, you can send a rep anywhere.
Yep. Total control over activities. If you want them flying to Alaska for a big potential client, the expense itself won't stop them.
But the downside.
Makes budgeting a nightmare. It's really hard to forecast costs accurately. And internally, it can feel like an open invitation to spend freely, maybe even pad the account a bit. There's zero incentive for the rep to be frugal. Why not stay at the nicest hotel?
Right. Which leads to the third way, probably the CFO's favorite.
You bet. The limited payment plan. This sets fixed limits, either per day, a per diem, or per item, like maximum $140 for hotel, max $44 for food in a day.
Helps with budgeting, for sure. Predictable costs.
Greatly aids planning. But here's where that management rep friction really sparks.
How so?
Well, your top-tier, high-performing reps, they often feel insulted, like they're being treated like rookies who can't be trusted with a company card.
Mm-hmm.
And worse, the inflexibility can actually lead to dishonesty. It brings us back to padding.
Because the limits feel arbitrary or too low.
Exactly. So reps might start switching expenditures. Maybe they go over the strict meal limit, so they'll pad their mileage claim a bit, where maybe receipts aren't checked as closely.
They feel they deserve the money, especially if they're hitting their sales numbers, so they just reallocate it themselves.
Kind of. They see it as fixing a broken or unfair system, not necessarily as cheating. As long as they're performing, what's the harm? That's sometimes the rationalization.
It really creates an ethical gray area, doesn't it? Is the rep defrauding the company? Or is the company's rigid policy creating the incentive to fudge the numbers?
That's the dilemma. The limit itself might be the root cause of the behavior.
Okay, let's shift to the biggest single expense item after salary for many sales forces. Transportation, specifically cars.
Huge cost. And the main decision, should the company own the cars, lease them, or just pay reps mileage for using their own yardage? It really boils down to one main factor.
Which is?
Annual mileage.
Sure.
How much driving does the job require?
Okay.
The more miles driven per year, the more it usually makes financial sense for the company to take on the fixed costs of owning or leasing the vehicle.
There was that calculation example, the indifference point.
Yeah, good illustration. Say the company pays 30 cents a mile if the rep uses their own car, but the company figures its own cost to own and run a car as maybe $4,000 fixed per year, plus only 10 cents per mile variable.
Okay.
You do the math, the indifference point, where the cost is the same, is 20,000 miles per year.
So that gives managers a clear rule of thumb. If the territory needs less than 20,000 miles driving.
Let the rep use their own car and pay them the mileage rate. It's cheaper for the company.
But if it's more than 20,000 miles?
Then, leasing or owning the car themselves usually saves the company money compared to the per-mile payout.
And leasing seems popular.
Very, especially for larger companies. It avoids a lot of administrative headaches of buying, maintaining, selling vehicles. And the savings can be real. One company saved like $2,000 to $3,000 per car per year by switching to a lease program.
Okay, finally, let's touch on the global angle. Doing this outside the U.S. adds layers of complexity.
Oh, definitely. Las diferencias culturas are real, and so are cost differences. Take driving in Europe.
More expensive.
Way more. Fuel can easily be $4 or $5 per U.S. gallon equivalent. And then you have the value-added tax, VAT.
Right, sales tax basically, but often much higher.
Yeah, it can hit 25% in places like Sweden or Denmark.
Uh-huh.
That adds cost and complexity to everything the rep buys or uses.
And simple cultural things can impact logistics too.
Sure. That example about Italy, if you need to rent a car away from the airport, many agencies just close for like 3 hours in the middle of the day for siesta or lunch.
So you have to plan your whole schedule around that, not something you'd typically worry about in the U.S. or Canada.
Exactly. It impacts the rep's whole day, their efficiency. You have to factor that in.
So wrapping this all up, it really feels like managing a sales force, especially out in the field, is this constant balancing act.
It's a total high wire act.
Yeah.
You're trying to juice performance with these powerful financial incentives, commissions, bonuses.
Push them to be aggressive, close deals.
Right. But at the exact same time, you need tight controls. You need rules, budgets, legal compliance, especially around expenses.
Give them fuel, but also apply the brakes.
Kinda, yeah. Encourage boldness, but demand discipline and documentation.
And it brings us back to that core idea about padding expenses.
Mm-hmm. The sources suggest maybe it's not always just
Mm-hmm.
an ethical lapse by the employee. Often it's a symptom of a problem in another area.
Meaning the compensation plan itself might be flawed?
Could be. If management sets an expense limit that a good rep genuinely feels is unfair, or just makes it impossible to do their job effectively.
And that rep then pads their mileage or kneel claim a bit to make up the difference they feel they're owed.
Yeah. Is that fundamentally the rep's failure? Or is it a failure of the system management created, a failure in the compensation or expense structure?
It leaves us with a tough question, really. Can you ever have perfect control over a field sales force? Can you demand maximum performance and absolute thrift without eventually crushing the morale of the very people generating your revenue?
That's the million-dollar question, isn't it? Something for you, the listener, to chew on. How much control is enough and how much is too much?